I'd like to head on over to the floor of the CME Group. That's the Chicago Board of Trade, where we have Scott Bauer, the CEO of Prosper Trading Academy, standing by to talk currencies. Scott, welcome to the show, and thanks for helping us get the week started right here on a Tuesday. It's all about the dollar this morning and how it continues to trend north.
Yeah, I mean, it's highs since April of 2017. It looks like it's going to hit that even par number at some point. And there's no stopping it at this point, Ben.
Yeah, I mean, one thing I'm noticing, Scott, is you've got the situation. There's a couple things playing out here. One is the rate differential. So the U.S. rates are higher than Europe, for example, Asian, basically globally, which brings about a specific and very specific interest to the dollar. But then also you've got a situation where we've got like the euro currency, you've got the British pound making new lows. I mean, it seems like the rate differential keeps the dollar bid, and then anytime we see a new currency like the British pound or the euro currency make a new low, we see new highs for the dollar.
Yeah, no doubt about it, and just the news everywhere is really so strength, and especially over the weekend, continued news coming out of England. They don't know what's going on there. I mean, Ben, you and I talked about this over the last several weeks. Was there going to be a possibility about more uncertainty and extending that Brexit deadline? And now it's actually in some of the talk there. Yeah. But it's really the continued uncertainty that is just really keeping pressure on the pound, and in that sense, strengthening the dollar and here and that's a big concern for U.S. companies moving forward is the strength of this dollar and earnings revisions. We might start seeing those for the third quarter due to the strong dollar.
Yeah, I mean, thus far it has really yet to be a topic of conversation, it seems like, in terms of some of these earnings.
You might start seeing it.
But it sounds like, yeah, you might. I mean, this is a significant move, and you mentioned the parity level there, but you also mentioned Brexit, and we're expecting a vote today. Basically, Parliament's trying to block a no-deal departure, ultimately kind of just pushing things off until January of 2020, I heard. But I'm wondering how much or how good that could actually be for the pound. I mean, they've been pushing this vote off for a while right now, and we've been seeing the trend environment to the downside. Ultimately, it seems like that's weighing on the British pound.
Yeah, I think maybe if that does happen, and it's probably a remote possibility, but if it does happen, you probably get a little bit of a pop. But the bottom line, like you just said, is there's so much pressure, and all that's going to be doing is extending out that uncertainty. The market does not like uncertainty. So after you see that initial reaction, I would expect continued pressure on the pound, stronger dollar versus it.
Yeah, this market, we've got a daily time frame up here, Scott. It has been and continues to be under pressure below the 120 handle briefly in the overnights here, back up above here, currently trading down by 1%. But let's talk about the RBA, Bank of Australia. They left rates unchanged at 1%. No shock there. I did see that Philip Lau said it is reasonable to expect that an extended period of low interest rates will be required in Australia to make progress in reducing unemployment and achieve more assured progress towards the inflation target. Scott, should we bunker down? Should we settle in for the long haul in terms of low rates here under the Australian markets as well?
There's no question about it. There's no quick fix. And, they're just following the rest of what's happening globally here. And, we're not going to see a change over the near term meaning 3 to 6 months. So I don't think it's a bad thing what they did. I think it's very prudent. But, yeah, Ben, this is for a long haul.
Yeah, certainly something to keep an eye on. Scott, how quickly do you think that this tone or this message in terms of low rates, and how quickly would this change? Should we see some sort of a trade resolution? You mentioned a near term in terms of the Aussie dollar, 3 to 6 months roughly. I mean, would this be something that would shift, do you think, overnight, or would it take a little while in terms of this unwinding of everything that's been playing out here and concerns in reaction to uncertainty in terms of U.S.-China trade talks?
Listen, if we were to get some sort of resolution, which is still, God knows how long, how far away it is, I think you see an initial pop. I think rates would probably pop back up just for the short run. But this is a more systemic type of risk. There's more issues going on globally than just the tariff issue. Now, that may be front and center, and that's why I think you get a quick pop in rates. Bonds probably sell off a little bit, but again, this is more systemic, this is longer term, and I think you're going to need a good 6, 9, maybe even 12 months post any sort of resolution for this to really pan out and things to stabilize.
Scott, one thing I noticed here, it's not just Europe, it's not just the UK. I saw some disappointing data out of Asia. I saw Asian manufacturing PMI weekend. Japan's August manufacturing PMI fell to 49.3 from 49.5, the flash estimate, and 49.4, the reading we saw back in July. And I'm wondering, because Taiwan trimmed theirs to 47.9 from 48.1, clearly not the trend that we want to see in terms of manufacturing data. And ultimately, though, it's been interesting because we're going to get some insight in terms of our own manufacturing data. Today we get the ISM. Do we think that we're at a point where that ripple effect is starting to be felt here in the U.S. as well?
I really do, and that's kind of my point, Ben, is you know, we're seeing these numbers, these manufacturing numbers get weaker and weaker, and just because there may be a trade resolution somewhere down the road doesn't mean that's going to change overnight. You know, it takes a long time. As we've seen with these PMI numbers going down, it takes a long time for the manufacturing sector to actually change, whether it's being more productive or less productive. So I think it is trickling here. I hope we see a stronger number here, but I wouldn't really count on it.
Scott, one more question, and I'll let you get on your way. We've got a big week ahead of us in terms of jobs data, Fed speakers. I mentioned the ISM number this morning and some other manufacturing data head our way. What are you going to be dialed in on most, and what should we be?
Yeah, the big number is Friday, and Friday with the jobs number is really, I don't want to say it's a make or break for the Fed. There is no make or break at this point, but you know, if we get a really nice number, a good robust number, you know, maybe that teeters them to the 25 basis point, you know, reduction. If we get a really weak number, you know, maybe we go 50. You know, so I think that's the big number that the market is going to be dialed in on. I think the Fed speak this week is all, you know, you can kind of throw it out the window. I hate to say that because it's important, but, you know, whatever they say this week is really not going to be consequential in what they do a couple weeks from now.
Yeah, not consequential, and potentially even more focus being on Jerome Powell to cap things off on Friday. But certainly we'll keep an eye on the jobs, Scott, and we'll keep an eye on the dollar. Really appreciate you joining us here to start the week off.
Thanks,
Traders,
man.
that's Scott Bauer. He's the CEO of Prosper Trading Academy. Scott, thanks to you.